I want you to imagine for a moment that you started investing in 1998. The world is going mad for the internet. New companies are popping up out of nowhere, and every investor is convinced they have found the next big thing. You pile into catchy .com names, your money climbs for 2 years, and everyone thinks you are a genius, until the year 2000. The bubble bursts. The NASDAQ falls nearly 80%, only 48% of .com companies survive, and even the world's richest people take multi-billion-dollar hits. The crazy part? The internet really was the next big thing, but overconfidence and hype created one of the biggest bubbles in history. Fast forward to today, and that same energy is back. This time it is not the internet. It is AI. People are calling it a once-in-a-lifetime opportunity. Maybe they are right, or maybe history is rhyming again. As John Templeton warned, the 4 most expensive words in investing are, "This time it's different." Is it actually different now? Let's look at the 3 hidden forces shaping this potential bubble, why they matter, and how you can position yourself to benefit instead of panic. Right now, the fate of the market is being decided by 7 companies, the Magnificent 7: Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia. Together, they make up around 36% of the S&P 500, and they are locked in an arms race to dominate artificial intelligence. Even if you only own an index fund, you are already betting on this race. And the spending is staggering. Tesla plans about $5 billion on autonomous driving and XAI. Apple, $10.7 billion to make Siri smarter. Meta, $60 billion for data centers and the metaverse. Google, $75 billion to rebuild the internet with AI. Microsoft, $80 billion for OpenAI and supercomputers. Amazon, $100 billion for AWS infrastructure. That is $330 billion in 1 year, more than the GDP of countries like Finland or Portugal. Some people call it the 4th industrial revolution. Others wonder how long this can keep propping up the economy. Global AI spending is expected to hit $500 billion by the end of 2026, and power and resources for electricity demand could top $3 trillion annually by 2030. The incentives are huge. The IMF estimates about 60% of jobs in the developed world are exposed to AI, meaning they could be transformed or replaced. No wonder leaders say moving too slowly could cost them everything. Here's where things get messy: the AI money machine. Chip designers like Intel, AMD, and Nvidia sell to AI builders like OpenAI and XAI, and to data centers like Oracle and CoreWeave that lease compute back to the AI companies. Capital flows in circles. Investors at Microsoft funded OpenAI with $58 billion. OpenAI paid Microsoft to use its data centers, Microsoft bought Nvidia chips, and Nvidia invested back into OpenAI. Each step can be recorded as revenue, pushing stock prices higher. Then came a massive OpenAI Oracle deal reported at $300 billion. Oracle said it would spend tens of billions on Nvidia chips. Nvidia agreed to invest up to $100 billion back into OpenAI, if OpenAI buys more Nvidia chips. Nvidia sells to everyone, then invests back into the same customers. It is like selling shovels, providing land, digging the quarry, and enticing the crowd. Yet no one has struck the profit gold vein. OpenAI is reportedly valued at around $500 billion with roughly $12 billion in revenue and is losing money monthly. Mid-video question for you. Is this brilliant strategy or a dangerous loop? Comment below with how you see it, bubble mechanics or a smart way to scale a new platform, and how you are positioning your own portfolio. There is a second pressure point, the data wall. AI has been learning at breakneck speed by devouring public data. By 2027, it is expected to have consumed nearly all human-generated online content. Progress that looked like a ladder might slow to square-by-square steps. We have gone from early, glitchy AI videos to much more convincing results, but if data becomes the bottleneck, expectations could outrun reality and trigger a reset. Can AI scale past the data wall? Possibly, but it is not just more data, it is different data. Meanwhile, investors must manage risk. Is this the dot-com bubble all over again? Not entirely. Today's AI companies have real utility and clearer paths to profits. But signs of a bubble still exist: overvaluation, recording circular flows as revenue, geopolitical mania, and scaling limits. The timeline is unknowable. This could be the start of a decade of wild investment or closer to the end than we realize. Here's a practical plan. Keep investing through the cycle with automatic contributions into a broad, low-cost index fund. That is how I lived through the dot-com crash and still came out ahead as markets recovered over time. Do not over-leverage, and avoid debt that forces you to sell at the worst moment. Increase your income. Promotions or side hustles give you the fuel to buy when others are fearful. Diversify across stocks, bonds, precious metals like gold, real estate, and even cryptocurrency. Consider dividend payers for cash flow in downturns. And subscribe if you want more grounded playbooks for building wealth through uncertainty. Whether AI fulfills the hype or stalls at the data wall, disciplined investors can win. The real question is not whether AI is a bubble. It is whether you are prepared to benefit either way.